Well, we have seen shares of Uber today under pressure, down more than 6%, despite posting a surprise earnings beat and its first ever GAAP operating profit. Here to uncover the challenges and opportunities of the ride-sharing giant, we've got New Construct CEO David Traynor, along with Paul Meeks, Independent Solutions Wealth Management Portfolio Manager. Welcome to both of you. We know you're on very opposite sides of the spectrum when it comes to where you view the stock. Paul, let's start with you because Uber really kind of pushing the positive news today, their first operating profits in the quarter, but they also had some of the slowest growth that we have seen since the pandemic began. So is this as good as it gets? Have we kind of reached the peak, at least in the medium term?
Maybe in the medium term, because, the stock is still up 90% year to date. So it's been a smashing success as of late. And for many, many years, since the company's inception, I was turned off on this company. But I've only become more bullish on it recently. And I actually think, not today, I think the stock has to come down and maybe show support at its 50-day moving average, which is $43 a share. I probably would be a better buyer. Because here's a company that's gone from deep losses to about break even at this point, surprise to the upside, particularly on free cash flow. And right now, the street has about 95 cents EPS next year. The way they are annualizing with the most recent quarter, I bet that could end up being $1.20, $1.50. And if I'm right, the stock is expensive, but deservedly so. So I don't buy it today. We successfully support the $43 price at the 50-day moving average, I would buy it there.
David, you're at the other end of this. You're not excited at all, I would assume, despite the fact that Uber did post its first operating profit. Why not?
Paul makes some good points. The business is way better than it was before, but the bottom line is that most of this earnings that we're seeing is from unusual gains related to securities gains. It's non-operating. 13 out of the 19 cents is fake. So this business is not looking as good as it may appear. And I think that's a big part of why the stock is down. Investors are smarter about adjusted EBITDA and the false sort of gods that this company has praised in the past. Look, any business that's been run on a number that really doesn't correspond to profits, you got to question. They burned $35 billion in cash. I don't buy the positive free cash flow number. We won't know until the Q comes out and we can actually look at the numbers. But I doubt that on a real cash basis that this company generated real cash flow. And again, they burned a ton. Going forward, I sort of see this as a peak. I just think the competitive position of this business is not that great. It's, you don't see many millionaire taxi drivers or taxi companies, right? It's not a great business. So I don't really see a long-term profit in their future.
Paul, let me get your take on, at least on the ride-hailing side, because we have seen, Uber start to benefit, on the one hand from the return to office. We have seen corporate travel as well as leisurely travel also picking up, that benefiting Uber as well. But they've also had to spend a lot to bring drivers back. So if you think about the trajectory of this company on the ride-hailing side since the pandemic began, are we at the peak?
I don't think we're at the peak. We'll see what happens next year. However, the thing that I worry about the most is, do we have a recession in the United States next year or even abroad? And my view is we will have a recession, yes, but it'll be rather short and shallow. So Uber and other companies will be able to not skate through it. They'll be impacted negatively, but be able to survive it. So I don't think we're near the peak on the ride share. And one of the things I like about this model, particularly vis-a-vis Lyft, which is a horrible company, the gang that can't shoot straight, horribly managed, at least to this point, and that is actually a benefit for Uber, is that they're diversified, right? With the transport business, which I see very potentially interesting over time, and also the delivery, which I'm kind of mixed on. But I could see out of the three pieces of the puzzle, transport could be quite interesting and a nice accelerant in the future.
Dave, let's talk a little bit more about that comparison that Paul just made to Lyft. I know you're not excited about the business model for Uber, but comparing it to its biggest competitor out there, it does have a huge advantage. How do you see these two businesses stacking up?
They're both bad businesses. Like I said, the taxi business, the rideshare business, it is a product of, I think, that golden sort of private equity age where they could take anything to market and sell it for huge profits, which is now a problem in the private equity space, but that's a different issue. These things were never unicorns. It's, again, not great businesses. I remember talking to a banker one time that was looking at Lyft, and I said, so at the end of the day, what is the competitive advantage of these businesses? Do they have one? And his only answer, the best answer he could come up with was, well, they can raise more money than other companies. So these firms are about burning lots of cash. And look, to Paul's point, it's a bad business, but competing against bad businesses that lose lots of money, I mean, you can never raise prices because they will undercut you. And that's going to happen forever, I think, in this business. I think it's a zero margin business long term. That's why bus services and things like that, you don't hear about Greyhounds making a lot of money. In terms of other businesses they're in, transport, also super competitive, low margin, intense rivalry business. Not likely they're going to go in there and disrupt anybody, make real money. And then food delivery, that's a joke. They'll never make money in food delivery.
David, I mean, what are you suggesting when you say the competitive advantage isn't that great? There's not a lot of money to be had here. I mean, that ride hailing is going away, or that you don't see a lot of upside. There's not enough revenue coming in. I mean, what do you mean when you talk specifically about the ride hailing space? That the advantage isn't great.
It's not going to go away. It's been around forever, right? What's the innovation here? Oh, that there's software that allows anyone to be a taxi driver. It's not exactly a livelihood that people aspire to. It's a hobby. It's not really creating value for anybody at this point, except for the executives and the bankers and the shareholders that are taking home billions and the consumers are effectively getting a value neutral proposition. It's not. I don't think there's a real sustainable value creation there. And it's a trading stock. It's a banker stock. And the executives are making tons of money. I think it's a transfer of wealth from consumers to the executives. And ultimately, when this thing really kind of settles back to earth and fundamentals matter again, it's going to be a big transfer of individual investors to institutional investors and bankers.
Well, Paul Meeks and David Traynor, I appreciate you both coming on, giving us your take on Uber as we see that stock under pressure in the session today.